After watching The Wolf of Wall Street, you probably think trading stocks can't be that hard, right? But in reality, real finance is brutal. On Wall Street, millions of dollars move every second. Entire firms compete to analyze the market faster than everyone else because even milliseconds can mean millions in profit. There are millions of stocks and trillions of possible portfolio combinations. Traditional computers must evaluate possibilities one at a time. As more stocks are added, the problem grows exponentially larger. Even the world's largest hedge funds rely on approximations because calculating every combination would take too much computational power. Now imagine trying to build the perfect stock portfolio while competing against hedge funds with supercomputers. That's where quantum computing enters the game. Using IBM's Qiskit framework, I built a quantum portfolio optimization platform powered by QAOA, or the Quantum Approximate Optimization algorithm. Instead of brute forcing every portfolio sequentially, quantum computing uses qubits, superposition, and probability amplitudes to evaluate many possible portfolio states simultaneously. This video is about how I was able to accomplish that and elevate it to the next level. First, I pull live historical stock data using Yahoo Finance APIs. This gives the optimizer real market behavior instead of fake sample data. Instead of training the system on random numbers, the algorithm analyzes how companies perform over time, including volatility, crashes, recoveries, and long-term growth trends. Quantum optimization is only as good as the data it receives. Next, the system calculates two major financial metrics. Firstly, the mean returns. This estimates which stocks are likely to generate profit over time. Stocks with higher average returns appear more attractive to the optimizer. Some of the highest returning assets are also extremely volatile, and that's why the second metric matters even more. This leads to the convergence matrix, which basically measures how stocks move relative to one another. If two companies frequently rise and fall together, they have a high convergence. If they move independently, they have a lower convergence. This becomes critical for diversification, as the balance between risk and reward is the foundation of modern portfolio theory. After calculating the financial statistics, the next challenge is translating the portfolio problem into a mathematics compatible with quantum systems. Quantum computers do not understand companies, profits, or stock tickers directly. Everything must be translated into mathematical variables and equations. To do this, I created something called a quadratic program. This structure allows the optimizer to define variables, constructs, risk objectives, investment limits, portfolio allocations. Each stock becomes a variable inside the optimization program, which each of them determine how much capital can be allocated towards each stock. Now, we need to transform the portfolio problem into a Hamiltonian. In quantum physics, quantum systems naturally evolve towards lower energy states. So, if we can encode the portfolio optimization problem as an energy problem, the quantum computer will naturally search for the most optimal solution. At this stage, the quantum computer can finally understand the financial system, with the market has been effectively translated into quantum mechanics. Our last step is running the QAOA. It begins by placing qubits into superposition using Hadamard gates, allowing the quantum computer to represent many possible portfolio states simultaneously. As more qubits are added, the number of possible combinations grow exponentially. Then, QAOA repeatedly applies two major operations. Firstly, the problem Hamiltonian. This operation pushes the system towards stronger portfolio configurations by assigning lower energy to better solutions. Secondly, it applies the mixer Hamiltonian. The mixer prevents the algorithm from getting stuck too early. Instead of locking into one answer immediately, it continues explores new portfolio possibilities. These quantum rotation gates allow the qubits to transition between states and search the optimization landscape more effectively. QAOA alternates between these operations multiple times. Finally, when the qubits are measured, the highest possibility quantum states correspond to the best portfolio allocations discovered during optimization. That becomes the final investment strategy generated by the system. With this optimization system, I decided to use and create a brand new website and service. Introducing Axum. Invest smarter. It transforms raw market data into a professional-grade quantum-powered trading dashboard. Features include portfolio optimization, expected returns analysis, volatility calculations, and Sharpe ratios. Correlation heat maps, interactive financial graphs, optimization comparisons, and real-time analysis. Instead of guessing investments manually, Axum mathematically searches for stronger portfolio allocations. You can download the project and check it out for yourself today.